Hi, I'm Kevin Gallagher, the Managing Director and Chief Executive Officer of Santos. Today I presented Santos' 2024 full year results, and I want to tell you a bit more about the year we've just had. Our strong financial results demonstrated the cash generative nature of our base business and the value of our disciplined, low-cost operating model. In 2024, we delivered free cash flow from operations of $1.9 billion, production of 87.1 million barrels of oil equivalent at the top end of our guidance, sales revenue of $5.4 billion, EBITDAX of $3.7 billion, and profit after tax of $1.2 billion. We also delivered compelling returns to shareholders. The board has determined to pay a final dividend of 10.3 US cents per share, unfranked, bringing total dividends declared for the year to 23.3 US cents per share. That's a total payout of $757 million, which is 40% of free cash flow from operations, in line with our commitment to shareholders. Since 2016, we have returned more than $4 billion to shareholders. That's more than the entire market capitalization of the company back in early 2016. One of the highlights of 2024 was delivery of our Moomba CCS project, which will store 1.7 million tonnes of CO2 per year, equivalent to taking 700,000 cars off the road each year. And we're on the cusp of delivering our Barossa and Pikka projects, which will set the company up with new long-term production and revenues for the future. With Barossa and Pikka coming online, Santos' production is expected to increase by more than 30% by 2027 compared to 2024. This will lower unit production cost and put the company in a great position to generate cash and return value to our shareholders. Our Barossa gas project is now 91% complete and remains on schedule for first gas in the third quarter of this year. I'm excited to announce a key milestone has been achieved this week, with the final welds on the Darwin pipeline duplication underway today, which, when complete, will connect the Barossa field to the Darwin LNG plant. 3 wells are drilled and completed. The 4th well is partially drilled and suspended for later completion. And production from these 4 wells can deliver nameplate capacity, materially de-risking the project. Our Pikka Phase 1 project in Alaska saw strong progress and remains on track for first oil in mid-2026. The drilling program in Alaska continues to be a success, with a 25% improvement in drill time on the last 6 wells and a new technical limit record recently achieved. With these projects coming online this year and next, now is the time for us to focus on resetting our disciplined, low-cost operating model. Following on from the cost refresh we signalled at our recent investor briefing day, we are targeting $100 to $150 million in annual structural savings from our operating costs and sustaining capex over the next 1 to 2 years. This will be supported by a thorough review of all of our costs across the business and our supporting functions. Following on from our success in delivering synergies from our mergers and acquisitions of recent years, I am confident we can deliver these savings. Smart deployment of technology is a key focus area. It's also time to look to our future. The company has a robust suite of high-quality growth options, including Papua LNG and other PNG opportunities, Beetaloo, Narrabri, Pikka Phase 2, and, of course, Dorado. We will be working to mature and select our future development projects in a disciplined manner to maximise shareholder value and align with our post-2026 capital allocation framework. Our unrelenting focus on sticking to our strategy has set the business up for an exciting 2025 and to deliver long-term value for shareholders. Thank you.